Hello folks, Armando Barbosa here with Vision Mortgage Company, bringing you the Vision Mortgage Minute. Today is April 24th, and happy Fiesta for those that are out there doing the Fiesta. I'm here celebrating, watching it on TV from last year. Anyway, happy Fiesta to everyone. Today's topic, the challenges that we may be seeing in the mortgage market as a result of the coronavirus. What else will we be talking about? I mean, look at CNN, that's all they talk about, right? So what about the shift in the marketplace? And this is something that I have seen, we've talked about it before, and that is, here's the government mandating that if you've been impacted by the coronavirus, and I sincerely hope that if you have, that you are able to heal from it as soon as possible, but mandating that if you simply raise your hand and say, I can't make my mortgage payment, the mortgage company has to essentially forbear or not accept your mortgage payment for a minimum of 3 months, could be as long as 6 months with renewal. So what is that having? It's having a devastating impact on our lenders. And you say, well, how does that impact me? Well, if you're thinking about buying a home, you should be concerned. So we've had unemployment rates. Unemployment rates have jumped to 4.4% in March of 2020, and that's the highest it's been since August of 2017. But what is the market expectation? The market expectation is even further unemployment. We increased from 1.35 million people unemployed to 7.14 million people unemployed, and that's a huge increase, and it is expected to continue to grow from that point. I mean, the population in the United States is only 330 million people, yet we are experiencing that we may have as much as 20 to 25% unemployment. All right, I don't want to be Chicken Little and say, hey, the sky is falling, but you know, historically, what's happened, even in the Great Depression times when we had unemployment at rates of 25%, and incidentally, if we hit that rate again, we'd be at the pre-epidemic rates of some countries, some third world countries. Mozambique, for example, had a 25% unemployment rate. So, what do we do? The shift. What's the shift that I'm talking about? The shift is to less risky loans. Mortgage lenders are shifting their eyes and saying, we want to be able to make sure that whoever we put on the books can certainly make a payment. That's understandable, right? And why? Well, because of this forbearance situation, they're having to pass through those payments to the bondholders, the people that they use to basically provide the capital for our market. So, with that in mind, what we're likely to see is a move towards government-backed loans, and that would be FHA, VA, USDA, and of course the GSEs, which are the government-supported enterprises like Fannie Mae and Freddie Mac. So you say, well, what about the other guys? Who was the other guys? Well, the other guys were the jumbo loan market, who are taking a tremendous beating in this current economic scenario, and something that we've been emphasizing for months and months, the non-QM loans. What are the non-QM loans? These are the borrowers that are trying to qualify with bank statements for income, for example, under the asset depletion program that we've talked about in the past. Those folks are taking a back seat, unfortunately, to the marketplace, and we've seen some tremendous restrictions. If you're trying to qualify on anything other than tax return income and a good, strong FICO score, we need to talk, because it's going to take us a little more searching. And the good news is, as mortgage brokers, and that's just not myself, it's anyone that's a mortgage broker that you're working with, we have multiple sources. We don't have just, as I always say, if you have red shoes, you only sell red shoes. Well, we have red ones and blue ones and green ones. We have the entire market to deal from. That's the advantage of using a mortgage broker, and certainly the advantage of using Vision Mortgage Company. So how should you be preparing? First of all, obviously, make your bill payments on time. And I don't know about this forbearance situation. You know, you can't just flip a switch and say, we're not going to show those as late payments on your mortgage. I mean, what if you do have a late payment because of it? It's going to take time to undo what's happened on your credit report. And you may not have that time if you're looking for a home now, or you're having to sell your home and move it into something else. Save money. if you can. I mean, this must be, this is a critical question. If you have a job and you're able to, and you're going to be looking for a home, certainly you want to save some money, because now what's going to happen is these mortgage companies are going to be looking for something called reserves. You know, with an FHA loan, you could close with absolutely zero money in the bank after the transaction's done. And that's going to be a move that you're going to see move away from somewhat, because they want to see that you have a little kitty, a little fallback cushion in the event that mortgage payments become a little bit tight for you, or perhaps you lose your job. That's not a good thing. Be prepared for a greater investment. Be prepared to make a little bit more down payment than we had in the past. That also lends itself towards something that's an anomaly of this marketplace. This happened in 1981. I've been lending in this market since 1979. In 1981, in 1998, and 2009, we saw things that crept into the marketplace called loan discount points. Loan discount points are fees associated with getting a particular interest rate. Lenders, as I mentioned, are moving again away from to a risk-less type of transaction, and they don't want to put loans in the books at a higher rate. For example, at the regular rate of 4.25%, they'd like to put it more in the 3.75%. They don't want the loan to refinance in the future. They'd like to leave it in the books for at least a couple of years. So with that in mind, you're going to see loan discount points creep back into the marketplace. If you're a seller, you may have to be considering paying loan discount points for the buyer. That turns the shift from a seller's market to a buyer's market. Unfortunately, as the months come along, and if we do see continued unemployment, we're going to see some folks maybe having to sell their homes at a time when they didn't want to sell their homes. And that is not necessarily dumping, that's simply trying to get aggressive with the sale of an asset. But in many cases, that's going to hurt our market, because they'll be selling at prices below what the normal market rate should be. So be prepared for perhaps a glut of homes on the marketplace. That's not doom and gloom. But just so you know, I mean, I checked out a news article in Express News just this morning, a gentleman named Michael Taylor, and he talked about post-pandemic times in the past. And one of the things that he did point to was two things that I think are very positive. One is that interest rates typically drop a minimum of 1% on post-pandemic times, and they stay in effect for like 40 years. That's incredible. That's beyond my lifetime. And then second to that, higher wages. Higher wages is something that we can look towards for economic news, and this is historical. So give us a call if you need some help. It's Vision Mortgage Company, 210-348-0077. Like us on Facebook. Check out our YouTube. All these Vision Mortgage Minutes are available for you and your family. I wish you a safe and happy summer as we get close to summer. Hopefully some of what the president is saying is correct, and maybe the heat will, and sunlight rather, will kill the coronavirus faster than we think. We'll see. As always, happy house hunting.